everyone? Eric here again. This is my closing trade alert for First Solar. This First Solar trade really tested my patience and it got a little hairy there for a while, but this is one of the strangles that I've been referring to in my other videos that really just became a nuisance, and I almost bailed on it a few times for a loss or even a really small profit. But ultimately, I think I came out with about $85 profit per contract. But man, yeah, it was just a real test in patience, and man, I'm done with strangles for now. I'm just tired of rolling out the call side of things. This market is just way too bullish. Everything just gets huge overreactions when there's positive news, and even sometimes when there's bad news, there's still spikes up in price. It's just crazy, and that's kind of what I found myself in this scenario here. Anyways, quick rundown here. I initially sold back in mid-December the 105.72.5 strangle. The 105 call had pressure on it, and so in early January I was getting close to the expiration, so I rolled it out to February, and luckily I was able to get a much better strike at 115 versus my 105. And I will give this trade a little credit where I'm getting a much better strike and a credit in price when I roll it, where some of these other trades I've been in, man, I've been just stuck at the same strike and the price just keeps going higher. And one of them I just had to bail with a huge loss because it was already going against me, and then there was a massive spike up in price one day, like overnight, and I just said, screw it, I just got to cut my losses and move on, even though it was like 15% of my whole account. Not just 15% on the trade, 15% of my whole account. It sucked. But anyways, it only takes one time, and you're never going to want to trade a strangle again. So maybe if the market is really bearish, you could go for strangles, but in a normal market that's sideways to up, trading strangles is extremely dangerous. In my opinion, you're just rolling the dice, and it's only a matter of time before there's going to be a huge move against your call strike, and you're going to be down thousands of dollars in the blink of an eye. So anyways, that's a different video. For this one, we need to do a little bit of math here to make sense of everything that went on. So I opened the trade here for a credit of $1.65. I then got pressure on the call side, and I had to roll that out to the February expiration. When I did that, I had to close the trade for a debit of $3.65. And so that left me with exactly $2 loss, or $200 loss per contract. I then rolled that out to February here for a 115 versus a 105 call, which is great. I got a credit and a much better strike. So I rolled that out for $4.25, which grand total, that gives me $2.25 credit on the overall trade. And then I waited basically all of January and finally was able to buy it back for $1.40, which is a debit. And that left me with 85 cents profit per contract on the trade, which equals $85. All right, let's head over to the chart to see how the trade played out. All right, so I opened the trade here on the 14th of December 2020. The price when I opened was around $86, $87, somewhere in there. And then immediately after, it just went against me basically the whole time. And you can see the next day here, it shot up over 5% and then just kept going from there. So it went from like 87 all the way up here to like 107, which that breached my 105 short call right here, right? This is the original strike that I had in the January expiration. Now technically it never closed above there, but at this point, at this vertical dash line here, it was getting kind of close to the expiration, and I didn't want to risk having such a big move against me because it's more money. So on the 4th of January, I rolled it out to February, and I went from the 105 short call up to the 115 short call. So I roll it for a credit, and I got a better strike. I got a much better strike, actually. And boy, am I glad that I did get that 115 strike, because as you can see here, I rolled it on this day. The next day had a big day down, but then man, the very next day had a huge day up, and then it went up again. And I'm so glad I didn't have the 105 at that point because this was past my break even. But luckily I had the 115, and it technically never even touched the 115, but man, for a couple weeks here, just hovered right around, 105 up to 108, almost 110 area. And then even here on this day here, shot way up here at one point to 112 or more. But then luckily I had a couple big days down here, and then I think I closed it out right around here. And finally, after 2 months of being in this trade almost, well, a month and a half, give or take, I was able to close it out for a decent profit actually. But man, it was pretty hairy there for a while. And a lot of this stuff right in here was when all that shenanigans with GameStop was going on. And I was real nervous that people were just going to start covering their shorts, which then would make this price skyrocket. And I think this day here, when it went up this much, I think that's exactly what it was. I think people were nervous that all their trades were going to get stuck in a short squeeze, and so they just cut bait early and they didn't want to risk it. And I think that's why it had such a huge move up on this one day and then came back down, luckily for me. But yeah, anyways, this kept me in the trade for a long time, and I should have seen the writing on the wall, because this one, even though I came out ahead, I had another trade that just totally went against me. And that's exactly what happened, where I think everyone covered their shorts and it just blew through my short call and I lost several $1,000s. So anyways, that's a different video for a different day. Thankfully, this one played out in my favor. One quick note before we go over the summary. This original 72.5 put, I just let that expire worthless, because at this point when I rolled the trade here, this 72.5 put was so far out of the money that it was essentially worthless. And so I just left it, and sure enough, it expired worthless, and I got to keep the whole portion of that leg of the trade as profit. All right, so the rundown here, the whole trade took 44 days, which that's definitely a long time, even when rolling. I mean, you cut that in half, that's 2 trades of 22 days for a strangle, which then turned into just a short call. And once you hit 3 weeks for a naked premium trade, that's starting to get pretty long. And certainly with the naked call up here, I sat on that for almost a month waiting for that to profit for me. So yeah, definitely stuck in this quite a while. Luckily I came out with some money, but it could have gone the other way for sure. And when it was sitting around here, I was down money this entire time until it finally came down into here, I think. Anyways, the percent of my max profit is 37.8%. Now that gets a little tricky because that's 37.8% of my rolled trade. My initial trade was $1.65 and I collected $85. So that's about 50% or a little bit over 50%, right? But since I rolled it, my rolled amount was $225. And so 85 out of 225 is only 37.8%. And then the same thing, the return on capital, that's lower too, because again, that 5.7% is from the rolled trade amount. The initial capital required was about $2,000, but then when I rolled it out, I basically doubled what the required capital was. It was somewhere around $4,000 or even a little bit higher. So had the original trade played out, I could have made more like 10% here instead of 5.7 with the total rolled amount capital required. And then lastly, I had the $85 profit per contract. And yeah, that's about it. I mean, I guess this is a good example of how a strangle can go against you and why I am probably not going with strangles anymore. I'm just tired of getting burned on the call sides here. Luckily, this one worked out, but I have 3 other trades that aren't part of these trade alerts. They just have gone against me, and luckily they're not horrible, but they've just tied up a bunch of my capital, and I'm just waiting and waiting and waiting for a correction in the market to get me out of the call side of the trade at a decent, either profit, or most likely I'm probably just going to cut bait at a reasonable loss instead of right now. A couple of them are like above $1,000 loss per contract. And I'm just trying to get it down to like even 500, which is more manageable. I mean, I guess I'm lucky I have the capital to roll with it, because otherwise, if you didn't, you would have just taken a loss by now and just moved on, which frankly, in some ways might have been better for me anyways, because I'm tying up like 10 grand to capital just to make back like $1,000. Whereas that 10 grand could go into like 3, 4, 5 different trades, right? And that could be all making me money right now, where now it's all tied up trying to gain back some losses. Anyways, if you were looking for an example of a strangle and how they work, and specifically how they can go against you, this one is a pretty good example. And frankly, I'm lucky that I could roll for a better call strike here to 115. I mean, I got not even just the 110, but the 115, which was amazing. My other positions that I'm stuck in, I'm just stuck here at the 105. So if I was still stuck at the 105, you know, I would be still in that trade. I can almost guarantee you I would still be in that trade, waiting for it to come back around. I mean, maybe here, since it came down, I could probably get out with a smaller loss, but I certainly wouldn't be sitting on an $85 profit per contract. It would probably be a loss at this point. I should have checked before I made the video, but oh well. But yeah, so luckily I could roll for a better strike and a credit, where a lot of times, or sometimes, you can't do that. You can only roll for a credit and you're stuck at the same strike. Anyways, all that to say, I am definitely shying away from strangles, and I will be changing to jade lizards going forward, which is just like a strangle, except you buy a farther out of the money call, so your max loss is capped. And actually, if you set it up properly, you can guarantee yourself some profit to the upside if the price just goes crazy and goes up, right? So that's pretty cool. I mean, a lot of times it's real small, like 10 bucks or something, but either way, whether I'm locking in a very small loser or a very small winner, it's just so much better than taking the risk of this breaching your call and losing hundreds, if not thousands of dollars, because there's no protection. It can just go against you. And when the calls go against you, it's dangerous because they can really get away from you quickly. Whereas if it goes against the put, you know, unless something major has happened with that company, you can just roll it out and roll it down to the next put and then go out farther in time. But man, if there's really good news for a company, the stock price could go up and then it could just stay up for months or years, right? I mean, where the overall bias in the stock market is prices go up for stocks. So if your put gets breached, in my opinion, just generally speaking, your odds of recovering from a breached put are way better than recovering from a breach call. So anyways, it's obviously going to be a case-by-case basis, but man, these last couple months, even though I've gone a long time trading strangles, apparently I've just found the perfect setups every time, and those strangles worked out great because I never lost one until about 2 months ago. And now I think almost every strangle I had in the last 2 months, which was like 5 or 6 of them, I think all 5 or 6 had the call sides breached, and then I've been dealing with rolling them out and just tying up a bunch of capital trying to get some of my losses back. So anyways, I'll be switching to the jade lizards if I ever feel like getting a range, or an iron condor. I could do that too, but I like the jade lizards better because they just work a little faster. Anyways, I've rambled on long enough. Thanks for tuning in. Trade small, trade often, and I will see you in the next video.